What's up, everybody? Welcome to More Than Mortgage, episode 48. Zach Jones, Chad Anderson. We're both a little tired. We're a little groggy today, but the day of recording. So anyway, we're going to get through this one, though. Super simple, quick. You're going to love it. This one will hit home because I guarantee you, I'm going to go out on a limb here, Zach. I guarantee you what we're about to say. Somebody at some point was told the complete opposite, and that is PMI, private mortgage insurance, or MIP, if it's on the FHA side, mortgage insurance premium, is a bad thing. We are here to tell you and actually show you factual data as to why those arguments and your dad or your cousin or your plumber's best friend's second aunt, whatever, we are here to actually debunk that today and show you factual numbers. Zach, PMI, I love it. Everybody thinks I'm nuts, but I'll let you start because this is actually one of those good things.
Yeah. So let's define PMI to begin with. PMI, private mortgage insurance. This is a product that came about in lending when, maybe it was the government, maybe it was Fannie Mae, maybe it was Freddie Mac, maybe it was the private banks. At some point, there was this discussion that came about in mortgage lending that says, we're missing a lot of people in the opportunity for home ownership because we require a 20% or a 30% down payment on houses, and that's hard for people to save up. So how do we mitigate our risk or reduce our risk and our exposure as lenders and actually loan more money to people who have less skin in the game? So can we get down to 15% down or 10% down or 5% down? And somewhere in that discussion, the insurance business or somebody who's really smart says, hey, wait a minute, we kind of do this over in the insurance world. We assess risk and we charge a premium to offset that risk. And this big risk pool, if we can collect premiums from all these people, then when this one person over here has a problem, we can pay them out.
Yeah.
And the mortgage business says this is brilliant. So basically, mortgage insurance is something that you pay in one way or another on loans that have less than 20% down. So you're borrowing more than 80% of the value of the property. And this mortgage insurance product actually protects the lender. Very important distinction. Some people think, well, if I stop making my payment, the mortgage insurance is going to pay on my behalf. That's a different deal. And we don't fool with that in the mortgage business. That's a private kind of a term life policy that people will call you about after you close. The mortgage insurance actually protects the lender in the event that you default, and it pays them out damages until they liquidate your property after foreclosure. That's a very oversimplified way to look at it.
Yeah. Go ahead. Keep going.
No, so I was going to say, mortgage insurance has gotten a bad rap sometimes in the past because there's this old school idea that we always want to put 20% down on a piece of property so we don't have to pay this monthly premium. It's been demonized in some markets because it has been very expensive in some markets, especially post-recession, coming out. We're coming out in 2012, 2013, 2014. The mortgage insurance industry has been hammered for 4 years on foreclosures because of the big giant meltdown and the Great Recession. And so the risk is high, the premiums are high. But what's the best news about that? That's a cue for you, Chad.
Oh, thanks. I don't know, Zach, tell me.
We're off our game a little bit because this is the night after the election, and Chad and I were up all night watching the election returns. So.
We're recording. It's 11:45 a.m. I've had 5 cups of coffee, and I'm not talking about the small ones. I'm like everybody's looking at me weird. I'm shaking over here. All right, on PMI, here's the deal with it, is that I don't know. I truly don't. I'm not being a smart ass with this comment, by the way. I don't know when and where and how back in the day 20% became the number, like 20% down to I don't know the backstory to that. I really don't. So somewhere along the lines, though, they said, hey, 20% down, you don't have to have PMI. I actually think it was even more before that. It wouldn't surprise me if it was more like 30, 40, 50% down way back in the day, talking like the 1920s or something, if you wanted to get loans and whatnot. But So here's the thing is that one, with mortgage insurance, the bank is literally saying, we will take on, think about this, okay? You can do 3% down or 3.5% down. Yes, I know there are 100% programs, but follow me here. You can do 3% down on a conventional at times, 3.5% down on an FHA loan at times. And the bank is saying, we will take on 97% of the risk and let you keep the entire amount of the asset growth. Think about that. Like literally, where could you go and say, hey, I only want to put in 3% of my own money. Can you let me have 97% to go buy this thing? Oh, and by the way, I want to keep all the asset appreciation that comes with it over time.
Mr. Wonderful would not offer you a deal on that.
No, not at all. No, not even a royalty deal. Not even a royalty.
None of the sharks are going to buy into that one.
No. Like that's insane when you think about it, right? So what they're doing is you're essentially subsidizing any foreclosures. Like Zach was describing, you are subsidizing foreclosures around the country. Now with FHA, you have this thing where they're not supposed to have more than a certain amount of money in their pool. They have way too big of a surplus right now. Like honestly, their MIP monthly or annually or whatever should come down. They have that much extra going on right now. I don't know the exact data on Fannie Freddie. I know FHA's, but either way, you're subsidizing any other foreclosures. So when what hits the fan, people don't pay, then that's the deal. So when people say, oh, you don't want to pay PMI, it's a waste, or when certain influencers out there on radio shows and social media are like, you shouldn't buy a house so you have 20% down, it's not right. It's not right. I don't understand why people are okay paying interest rates, but they're not paying PMI. PMI is just an additional interest rate. So I want to get into some math for a moment because I really want, and I don't have like a fancy screen share or anything today. We're just going to do this verbally because it's simple. I'm going to use my calculator here on my half broken iPhone 13 because Apple has started to make it suck as it approaches its end of its contract. It's another story. So not the shouldn't have gone down that rabbit hole, Zach. All right. So the example I gave yesterday was with a guy, he's a repeat buyer. Okay. He wants to buy a house, sell his home, buy another one. And we talked about it. And I said, I don't know that I would just take all my equity and dump it into the next house. Things are more expensive. Inflation's higher. Cost of living's a little higher right now. You want a rainy day fund. So he's like, well, what are my options? I said, well, you can do 5% down, 10% down. He didn't qualify for 3%. So it's 5 or 10% down, 15% down, 20% down, whatever. He's got enough to put 40% down. But I just said, you make the decision, but I just want you to understand the math behind it. Okay. So Zach, let's do 5% down on $500,000 because that's what he was wanting to buy.
Okay.
So 500,000, right? 5% of that is 25,000. We all follow on that.
Mm-hmm.
Okay. Loan amount then is 475. Okay. Everybody follows 500 minus 5% down payment, 95% loan to value, 475 is your loan amount. The PMI factor for him based on his specific credit score, this is not a blanket. It could get better or worse depending on your credit, but his situation, it was around a 0.4 factor. So what that means is we take the loan amount and we multiply it by 0.004. That's $1,900 a year. So included in his payment is going to be an extra $158.33 in his mortgage payment. That's what it costs him. He was like, well, why do you love PMI? He asked that question. I said, let's think of it this way. What does it cost you to avoid PMI on a $500,000 loan?
$168. Or no, I'm sorry, $100,000.
$100,000, right? He's putting in $25,000. So he's saving $75,000 out of pocket, right? Take $1,900, which is the annual cost of his PMI. Divide that by $75,000 because that is the amount of money he is able to keep in his pocket. So essentially it costs him $1,900 a year to keep $75,000 in his control. 2.53%. Where can you today go unsecured, borrow $75,000 at 2.53%? It's not a trick question. The answer is no.
Right.
It's nowhere.
Right.
You can't find that money. You can't do it. You cannot find $75,000 for 2.5%. Now, some people will say, well, yeah, Chad, but now your interest amount, though, is higher because your loan amount is higher. So you have a higher interest payment. Okay, fair. 75,000. All right, let's continue the math. 75,000. All right. Did you know that every 10,000 is approximately $60-ish per month on your mortgage payment? Okay. So let's take that, and that breaks down to an extra $450 of payment. Now, not all of that is interest, though. Okay. About 3/4 of that is interest. So times 0.75, 330.75 times 12 plus 1,900. Whoops, did that wrong. What did I say? 75,000.
75.
I had it for it was 450. That's what it was. 75% of an extra 450 times 12 plus 19. 337 times. I'll get it. I know this is boring now, but I'll get it. I'm hell bent on getting it. 6619. Okay, divided by 75,000. 8.8%. Same thing though. Where could you go today? Okay, to get. Now the other difference is that's your mortgage payment. It's not really an extra fee. That's just the election to have a higher loan amount versus a lower loan amount. The real penalty is the PMI. So whichever side of the fence you want to argue, my whole point is that if we're just basing it on the PMI, it's 2.5% to keep 75 grand in your pocket. If you want to take it a step further and include the interest that you pay in addition because you have a higher loan amount, you're looking at around 8%. Again, where could you go borrow $75,000 unsecured for 8% in today's market? You couldn't, right? You can't do that. So it's better off to have it, in my opinion, savings account, a CD, a market account, much more liquid even. Banks will give you a good return on that money in today's world, 5-6%, something like that, 4 to 6%. If you wanted to put it in there, that eliminates the PMI part. So I just wanted to do the math. Like, the facts are that the math actually favors. And that is also, I won't do another math scenario. We talked about doing two. I'm just going to do one. But in that world, that's the worst case PMI for this guy because that's only 5% PMI.
Yeah.
That's the highest PMI. If he did 10% down, it would be even lower. Like his annual rate of PMI would be like 1.5%, 1.25%.
And so that's a higher factor. I'm assuming that that's probably based on a little bit of a depressed credit score, just a little bit, because that's higher than I would have expected.
Yeah,
I want to touch on a couple of different math examples that I'm going to go through.
Let's do it.
Really simple. So in Chad's same example, let's say that it's a 8 or 8.5% cost to maintain that $75,000 out. But if that same customer then went and paid off credit card and automobile interest or RV interest or a jet ski loan and credit cards that in combination had a blended rate of 14%, then you're trading, you're taking $75,000 worth of 14% interest and you're making money on that if it costs you 8%. So that's one example. But I'm going to go over to the other side, which is probably where mom and dad get involved, especially dad, because he knows everything and he saved up 20% and did it because the guy on the radio show told him to do it 25 years ago.
Yeah.
So that first time home buyer, if that person waited to have 20% down on a $500,000 purchase, even if the future value, it took them 3 years and the house was still worth $500,000. Mm-hmm. The difference between that, if you, for the price of, the point that I'm trying to make is that for the price of $70 a month, if you go in there and you buy with 5% down instead of 20% down, or 10% instead of 20% down, then the average appreciation on a piece of real estate at 5% is going to make you over $2,000 a month on that $500,000 home.
Yeah.
You're going to pay $70 a month in mortgage insurance so that you can start accumulating equity at the rate of $2,000 a month.
Yeah.
That first time home buyer example is critical, because one of my campaigns right now is talking to people about what's going on with your kids. You know, they're starting their families. Are they renting? What's happening? Because I really believe that parents who have the ability, who have the means, really should be strongly considering trying to help their kids out getting into a position to buy a home, because when your median house price in your market is $400,000 or $500,000, it's so hard to get a start. And they're, you know, even at 5%, which is an average kind of lackluster appreciation, those values are going up so fast that young people can't capture it. They can't catch up, especially if babies are involved, because babies are so expensive.
I know. Yeah, it's, you know, you can really, this is one of those things, like, you're not just splitting hairs. You could start splitting the same hair 8 different ways. It's like an onion in this case, because, and I didn't go down that rabbit hole in the example I gave, but I've heard the rebuttal of, well, yeah, but you're paying higher interest, like I mentioned, right? Because your loan amount's higher. But the same thing could then be spun right back to them. And that's what you said is fine, but you're not factoring in how much appreciation I'm gaining by buying the house.
Right. Or rent that you're paying by not buying it. I mean, that's a whole nother factor that just blows the numbers out of the water.
Right. So when you factor in the appreciation that you would get either way, whether you put 100,000 down or 25,000 down, because appreciation is going to happen. Right. But if you're putting it into an asset and you're like, yeah, but it only cost me 25,000 to get into this. So now whatever it appreciates, that's just driving that 2.5% or 8% further down. So yeah, again, and like what you said, yeah, what if you're renting? You know, what if you do that? Then what's happening? You know, it's even more so.
So PMI is not the devil that it's been made out to be in the past.
Not at all.
And it's even more attractive now because PMI is a private product driven by in the finance industry. So these companies that offer PMI, of which there are several, have to be competitive. And so as the claims have gone down, because foreclosures are so low right now, that mortgage insurance has gotten cheaper and cheaper and cheaper and cheaper. And so they've all kind of fallen just like we wish that taxes would do, and we wish that homeowners insurance would do. If there weren't any homeowners insurance claims, guess what happens? Insurance gets cheaper because these companies are vying for business, and it's kind of a race to the bottom. And that's happened with mortgage insurance. So not the evil that we might have old preconceived notions about. It's a myth.
It is. So do some research if you'd like. Ask us, you know, hit us with a DM, whatever, text, call. If you got our numbers, we're pretty easy to find on the internet. You got our social handles right here at the bottom of the screen. You know where to find us, as we always say. I screwed that up every time. But yeah, to me, this is just a really important one. And we've been trying to dummy down some of these topics. We did debt to income ratio and how to pre-qualify yourself, basically, if you just wanted to get a vague idea of, can I even buy a house? We did that one last week. PMI this week. You know, just, I'm not saying, you know, start an argument with your dad, you know, or your mom or your granddad or your friends or whatever. Just unlock your mind that some of the traditional, same old stereotypical arguments, cliche comments, are not always relevant, and that times evolve, things change, perspectives, ideas. You know, there are just other ways to look at it through a different lens and whatnot. So anyway, I hope that helps. I love this conversation. I'm very passionate about it because I think PMI is a great tool. And so if you have questions on it, let us know. Hit the bell, like, subscribe, download, comment, share. You know, hit us up. We enjoy it. This is great. We're 48 episodes in. And we appreciate the additional subscribers we've gotten, the additional views that we've gotten on some of our more recent videos. And so truly appreciate everybody hanging out with us. So anything else, Zach?
That's all, man. That's all. Let's get it.
PMI, it's a good thing. You should enjoy it, embrace it, use it, leverage it, all the good things. It's great. Until next week, he's Zach. I'm Chad. Have a great one. We'll catch you then.
See ya.